To another edition. Firstly, welcome to Next Gen Professional Associates. My name is Ibrahim Akindele. For those who are just joining us for the first time, or you can call me IB, right? I'm the lead tutor of Next Gen Professional Associates. So I will be taking you 100% of strategic financial management. If you are just what is it called? If you are writing case study as well, I will also be taking a case study together with strategic financial management, right? So in today's class, we shall be looking at free cash flow, right? Now, the question is, what is free cash? What is free cash flow itself, right? Now, let me quickly take us to valuation of a business. We were supposed to take valuation of a business before free cash flow. Why? Because um the form of valuation, the techniques used in valuation of a business, you can still use a free cash as a form of what? As a form of valuation of a business. You can still use what? Free cash flow as a form of what? As a form of valuation of a business. Right? We're supposed to take business valuation, but there's no problem about that. After the free cash flow, we move to business valuation of a business. Now, what is free cash flow? Free cash flow means that, you know, it is what what is available to the company or to the firm. Then the organization will decide based on their discretion on how to use this cash flow. Now, what it means is that after deduction of all essential payments, what the company have or what the organization will have, it is what we call free cash flow. It is what we call what? Free cash flow. After deduction of essential payments, probably the payment of CapEx, which is the capital expenditure, that is non-current assets, the replacement, maybe you replace the assets, you pay taxes. After that, you adjust for your working capital. What you have, it is what we call free cash flow. It is what we call what? Free cash flow. All right. So the management can use it as their own what? Discretion. They can actually use it to invest in a business, right? Or they can keep it for future use, and that is free cash flow. Now, free cash flow is there for the amount of cash generated by the company that the management are able to decide how to use. Of course, that is why I've explained earlier that free cash flow means is a cash flow available to the company after deduction of all essential payments, right? So it is based on the management discretion that, oh, how do we use it? That is why it is free. That is why it is what? It is free because you can decide that, okay, I've paid tax. What else? I paid, what is it called? CapEx. I pay for CapEx, capital expenditure, then the replacement cost, changes in working capital as well, right? So after that, what you have now, it is what we call free, and that is why it is called what? Free cash flow. Now, in other words, it is the amount that they are free to use. That, of course, and that is why it is called what? A free cash flow, right? That is why it is called what? Free cash flow, because when you deduct all your essential items, what you have left, it is what you call what? Free cash flow. Don't forget that free cash flow is a form of valuation of a business. We'll get there when we get to valuation of a business, right? Now, free cash flow. Oh. Now, free cash flow to the firm, right? Free cash flow is divided into two, right? There is free cash flow to the firm and free cash flow to equity. There is free cash flow to the firm and free cash flow to equity. Now, what is free cash flow to the firm? Free cash flow to the firm is the cash flow available to the company, suppliers of capital, after all operating expenses, including taxes, have been paid, and necessary investment in working capital, that is inventory, and investment in non-current assets have been made. And this could be what? Free cash flow to the firm. Free cash flow to the firm is the cash flow available to the company suppliers. Who are the company suppliers of capital? those people who contribute money to form the business, right? That is what after cash flow available to the company after all operating expenses, including tax, have been paid, as well as the working capital, the non-current assets, right? If there is a replacement asset, a replacement of assets, right? And that is what is available to the supplier of what capital. Who are the suppliers of capital? Those who actually fund the business, right? So it will be at the discretion of the management to now say, oh, this is what we have. Do we want to invest this cash flow, or we want to actually use it. We want to actually use it for maybe for the purchase of future assets, right? And that is just, in a nutshell, what is free cash flow? Free, what is available to the company, to the management, after deduction of all essential items. It is called free because it is what is available to the management after deduction of essential item. That is why it is called free cash flow, right? You can use it, right? Now, free cash flow to the firm is um is a cash flow available to the company, suppliers of capital, those who contribute to the capital of the business, right? After deduction of all taxes, of course, working capital, of course, we already have an knowledge of working capital. Working capital, what you use to run the business, right? And investment in when you purchase an asset, right? And what is left for the company, it is called free cash flow to the what? To the firm. Now, having explained this, we move to the free cash flow to the firm, the format of free cash flow to the firm, right? In every question, when you're trying to determine the free cash flow to the firm, and this is usually the approach you need to use to determine the free cash flow to the firm, right? The profit after tax, right? You have your profit after tax, check from your statement of profit or loss, the profit after tax, you add back non-charge item or non-cash items, right? Right? What are the non-cash items? The depreciation. Well, if you have a depreciation, you add it back. Amortization, there's amortization of an intangible asset, right? Impairment of an asset, right? Then there's interest, of course, interest paid, right? Profit after tax, you have already considered what? In financial accounting, you've already considered what? Interest, you've paid interest, right? You have to add it back because what? It is a non-cash item, right? So when you are paying your interest, it is the net, right? It is the net. So it will be there are two ways you can do that. How much did you borrow? You borrow 15 naira, is that not so? From that, there will be a tax relief on that 15 naira, because don't forget that under the cost of capital, interest always attracts what? They always attract what is it called? Tax relief. When you want to determine the cost of preference shares, right? You want to determine the cost of preference shares, you say interest, open bracket, 1 minus tax rate. Why did you do that? Because there will be a tax relief on it, right? So you are adding it back because it is a non-cash item. Then the next thing is what? Is increase slash decrease in replacement of an asset class. Now, when you replace an asset, right, what will happen to your cash flow? Because we are talking about cash items now. Cash flow, right? Now, increase in replacement of an asset will actually reduce the cash flow. Of course, you have a cash flow of 15 naira, you purchase an asset, you replace an asset of 40 naira. What will happen to it? It will be 50 minus 40, you have 10. That is the reduction. So anytime you see that, oh, the replacement of asset is increasing, right, on year basis, it will reduce the cash flow. That is why I said increase slash decrease. Increase in bracket, while decrease. So when you see the replacement of an asset, right, decreases on a year-to-year basis, what it indicates? It indicates that you have enough cash flow because you did not spend out, right? You have enough, you did not expend any cash, any form of cash to purchase what, to replace what, any asset. Please, class, we need to understand this. Now, the next thing is increase slash decrease in non-current assets, which is our capital expenditure. Now, class, when you embark on okay, let me don't bring in project finance. When you let me just say generally, you want to embark on a project. Maybe let's talk about capital investments, or let's just talk about the capital investment, right? You purchase an asset maybe at year zero, right? So if there's an well, let's say 2025, we are in 2025, let's say 2024, we want to compare 2024 and 2023, for instance. Now you need to check, is there any increase in the asset? Do we buy assets over the years? Maybe you check your 2023, what is the current cost of the asset, the carrying amount of the asset, the net book value of the asset, right? And the 2024, you compare them, the two, you now look at it. Is there any increase or decrease in non-current assets, right? We'll get to that part, right? When there's an increase in a non-current asset, what does it indicate? It indicates that there will be a cash outflow. Of course, your cash flow will reduce. And when there's a decrease, it means that your cash flow will increase. Now, we also have increase slash decrease in working capital, right? Now, this is the format of how to determine a free cash flow to the firm, right? Free cash flow to the what? To the firm. The next is increase slash decrease in working capital. Now, what is working capital? We already know under the capital budget, right? What you use in running the business, right? I can decide that at the beginning of January, I maybe I invested 100,000 as a working capital for Next Gen Professional Associate. At the end of the fourth month, which is May, I will do what? I will recoup back my investment. But that is not in the case of this, right? That is not in the case. But it is what you use in what? In running the business. Now, what make up this working capital? We'll get to that part. So if what you use in running a business is increasing on a yearly basis, right? Or on a month-on-month basis, now what does it indicate? It indicates that there will be a cash outflow, right? Your cash flow will actually reduce, right? What you use in running the business, maybe in January you use 50,000, in February you use 150, in March you use 200, right? What will happen to your cash flow, right? What you generate, it will reduce, right? But when there is a decrease in the working capital, what does it indicate? It indicates that there is enough what cash flow, right? Your cash flow will actually increase, right? So that is why they say, okay, you have increase slash decrease in working capital, right? Now, don't forget, when there is an increase in working capital, right, what does it indicate? It will reduce your cash flow. When there is a decrease, it will be an addition, right, to your what? To your cash what? To your cash flow. With this now, you will now have what we call free cash flow to the firm. Don't forget, what is free cash flow? Why do we have to call it free? Because it is what is available to the company or to the firm after deduction of all essential items. And these are the all essential items deducted from the what? From the cash flow, right? So what is available now? It is at the discretion of the management to say, oh, we want to pay our shareholders, we want to do this, we want to do that, we want to do this, right? And that is why it is called what? Free cash flow to the firm, right? What is available to the supplier of capital after deduction of all operating expenses, non-current assets, working capital, and replacement of an asset. And that is what we call what? Free cash flow to the firm, class. And the question now is, what will you use to discount? Because at times, the question could tell you that, oh, what will be the present value of the free cash flow to the firm or to equity or to the firm? What will be the present value? It's just for you to discount that your free cash flow to the firm to the what? To the present value. You have your what? The present value of the what? Free cash flow. The question now is, excuse me, what will you use to discount, right? You use what? You use weighted average cost of capital to discount for this year, to discount the free cash flow to the firm. The question now is, why do you have to use weighted average cost of capital? The reason is because the weighted average cost of capital is for the firm, right? It is for the firm. Generally, it is for the what? Firm. Don't forget, refer back to the what? The cost of capital when you have the average, it is average sources of what? Sources of finance for the what? For the company, right? Now, you use what? Use weighted average cost of capital class to discount your free cash flow to the what? To the firm. Now, let me quickly explain the working capital, right? Let me quickly explain the working capital. Now, what is the working capital? We already know that it is what you use. Class, let me, before I explain the working capital, don't forget, if you want to know an increase or decrease in a non-current asset, let's say you were given 2024 or 2023, 2024. Now, the carrying amount of an asset, don't forget, an asset is being carried in a statement of financial position on what at cost. It's being measured at what cost, right? Now, you have in your what in your statement of financial position, you compare it, you look at it, okay? What do we have? What is the difference between the 2023 and 2024? Is there any increase in the what in non-current assets, or there's a decrease in the what in a non-current asset? Right? I need to say that again. Now, changes in working capital, what does that mean? Changes in working capital is just when you are doing a valuation of a business, for those who do valuation, right, in real life, in practical, when you build up a three-step model, from your three-step your model, from your profit or loss to balance sheet, from balance sheet to what is it called cash flow, from cash flow to the valuation of a business, right? Now, and when you get to evaluation of it, when you get to what is it called, cash flow statement, you have your changes in what in working capital, right? Now, what is changes in working capital? Working capital is what you use to run the business, right? Working capital is the difference between your current assets and your current liability. That is working capital. Your current assets minus current liability, it is what we call what? Working capital. Now, there is always an issue here, right? Please, let's really pay attention to this part. It's very important, right? Now, the current asset, what made up the current asset, right? The working capital, I'm coming. The working capital changes working capital changes affect free cash flow to the firm. Items such as inventory, account receivable, payable. Now, the definition of working capital exclude cash and cash equivalent and short-term debt. What it means is that when you say your current asset exclude cash and cash equivalent, right? Your current asset exclude what? Cash and cash equivalent, right? Then your current liability exclude the short-term debt, right? And again, do not include what? Non-operating current asset and liability, which is what? Dividend payable. You could see dividend payable under current liability, right? You now say, oh, it's your working capital. No, it is non-operating what? Current assets. You didn't, it is not operating, it is not part of what you use now to run the business. Dividend payable, right? So be very careful when you want to choose, when you want to calculate your working capital. Your current assets exclude cash and cash equivalent, and your current liability exclude dividend payable or the short-term what? Short-term what? Short-term debt, maybe an overdraft, right? And that is what we, so now when you are given, we already know the changes in working capital, the difference between this and that. We'll get there actually, we'll get there because we've done so many questions under the working capital in our what in our previous lecture. And this is all about free cash flow to the what to the firm. So do anyone have question? If you have question based on the my explanation on free cash flow to the firm before I move to the free cash flow to equity, you can quickly unmute your mic, right? You can quickly unmute your mic and okay, you can unmute your mic, please. Any question? Can we move on? Class, can we move on?
Sir, please explain this interest again. I didn't get it in the format.
Ah, something powerful man. So
Weak sometimes.
so the interest will be net now. There will be like a reduction. Don't forget under the cost of what do you do under the cost of capital? You have a cost of preference shares. How do you determine cost of preference shares? You say interest one minus tax rate, right? If you are to pay 9 naira before, you will not pay 9 naira or 9 naira, right? You end up for, because there will be a tax relief on that, and that is what it means. Do you get? So it's still the same. If the interest in the profit or loss is 10 naira, you now say 1 minus 10, which is the tax rate. So when you multiply, you have your what? You have your relief at the end of the period. Do you get that? And it is still the same thing as if the interest is if the interest is 50 something, if the interest is 50 naira and the interest rate is 9%, you could charge 9% of the 50 naira and deduct it from inside. So that is your net amount. That is your net amount. You could do it that way. Instead of doing it that way, that is why I say, okay, let's say we have interest, then you now deduct it. Well done. So I think that, are we good now?
Thank
Are we good? Yeah,
Yes,
right?
sir. Thank you.
Yeah. Rachel,
Please, my question is,
I
good
can't,
evening,
I
sir.
can't hear you.
Good evening, sir. Can you hear me?
Yes, please don't use bedroom voice for me. Oh.
Oh my God. Okay, my question is, does free cash flow, like the available free cash flow, does it include or exclude equity component?
Like I don't get.
Like from the definition of free cash flow, it said is the amount of cash that is available for management for use in any way. So the question is, the available amount, does it include equity?
Yes, yes,
Sorry,
yes,
I mean,
yeah,
debt.
yes. It is equity now, right? Equity and debt. This is it. This is it. This is how it works. What is free cash flow? I said free cash flow. It is what is available to those who contribute capital. Who are those who contribute capital? If you buy shares now in Dangote PLC, you are part of those who contribute capital to the firm. That is an equity, right? Those what is it called? And the other part of it, debt, maybe they borrow loan and all that. You are part of those who contribute capital to the business. Do you get, Rachel? So it's the combination.
All right, sir. Thank you, sir.
Mhm. Okay. No, now we are good, right? So don't forget, free cash flow is divided into two. We have free cash flow to the firm, and this is the format, and it is applicable. There's no question you want to solve under the free cash flow to the firm. This is what you need to do, right? Don't forget, the question may tell you that what will be the present value of the free cash flow to the firm. You use the cost of weighted average cost of capital. Sometimes you may have to calculate the weighted average cost of capital. Sometimes you may be given the weighted average cost of what? Cost of capital. So another approach is what? Free cash flow to what? Free cash flow to equity, right? Free cash flow to what? Free cash flow to equity. The question now is, what is free cash flow to equity? Now, the same thing, but different approach, right? Now, free cash flow to the to equity is the total amount of cash flow available to the what? To the investors, right? Now, if you buy shares, maybe from Jitco, right? You buy shares from Jitco, right? At the end of the period, they will tell you that, okay, this is what we have, oh, at the end of the period, after considering paying tax, after buying, we bought assets, we do this, this is what we have. So it is now the company dividend policy. Don't forget, it is now the company dividend policy to say, oh, we are talking about equity holder here. It is now the company dividend policy that, okay, we want to pay 3 naira per shares. We want to pay 50 kobo per shares. And that is what is available to the what? To the investors. What is that? And again is that when you have what is available to what? To the investor, it is not that you must pay the investors all the money that is available. No, it is not done that way, because there is still opportunity for what? For reinvestment, right? There is still an opportunity for what? For reinvestment in what? In into the business, right? Now, And what is available? It is what is available to the what? To the investors. That is the equity shareholders of the company, which is the amount company has after all investments, debt, interest are paid, right? It represents the potential dividend company can what? Can pay, right? Those people, don't forget that if you check my post on LinkedIn, I in the previous month actually post, I think I have to do the post again. I think I mentioned those companies that pay dividend, and I asked questions that do we have such company that does not pay dividend in Nigeria? You know, don't forget, under the cost of capital, and investors can what? Can get their return on investment in two ways, either through capital appreciation or through dividend. Is that also? Capital appreciation simply means increase in the share price. Now, increase in the share price means that as of today, probably one of the bank shares is 24 naira per shares, and you quickly go to the market, right? Using one of the stockbroker, buy the shares at 24 naira per share. Probably she bought 5,000 shares, right? At what? At 24 naira per shares. Now, by maybe December, the share appreciates, or there's a growth in what? In that particular share price to probably 50. You can see from 24 to 50, and that is about that, and from 24 to 50, and that is about 26% increase in the what? In the share price. Now, what does that indicate? That is you can get your return through what is it called? Share price growth or dividend, right? And that asks question that if you don't want to go by share price growth, you can go by what? Dividend. At the end of the financial year, the company will pay you dividend. However, there are some people we call what is it called? I'll remember. They are hungry of return on their investment. They are always inquisitive. They want to get return on their investment, and because of all those type of investor, that is why you will see some company we declare what we call interim dividend. What is interim dividend? Interim dividend is the dividend that will pay for to you before the end of the financial year, right? Some people pay twice in a year, right? Some people will say, okay, so that you will know that we put you it is what we call signaling, right? Under the dividend policy. Don't forget, you are sending a signal to the investor that we still have you at mind, though. Don't worry. Just take this, right? And such investors will be happy that, oh, at least he or she is getting return on its investment. So as an investor, you can decide that, oh, you want to go through market share price growth, or you want to go through what? Dividend what? Through dividend, right? And what bring about this? It is what is it called? Free cash flow to equity, right? What is available to the what? To the investor, right? So company that pay dividend. Do we have such company that does not pay dividend in Nigeria? Now that one is another discussion, another day, right? That is another discussion. So it represents the potential dividend the company can pay, right? Either you can decide that, oh, you make 50,000, you want to pay half of 50,000, maybe 25,000, right? To the what? To the investor. What is available after deduction of all items, right? It is called what? Free cash flow to the what? To equity. Now, how does it work? It is usually the profit after tax, add back depreciation if there is, right? Your profit and loss account, amortization of an intangible asset, right? Impairment of an asset, still the same, an increase slash decrease. Now, when you look at this format, you could see that there is no interest here. There is no interest here. Why? This is equity. This is equity. This is equity. There's nothing like interest here. You don't mention interest, right? Because when you want to determine the free cash flow to equity, you don't need to add interest, because this is what? Equity holder. This is for equity what? Holder. Free cash flow to equity. Sorry. Okay. Right? So something is different from here, right? you did not add back your interest because this is what free cash flow to what to equity. Next, you still have an increase. There's still increase slash decrease in working capital. Now, another thing is increase slash decrease in total borrowing, right? What are the, you know, don't forget at the beginning. Now, I have to make reference to what we have done so far, right? Don't forget that the cost of capital is divided into two, the cost of equity and the cost of debt. Don't forget that during liquidation, you have to pay debt holder first. There is an obligation that you must pay them the interest and principal at the date of the maturity. And that is why you have to have what total borrowing here. When you pay them, what is left is what we call what? Free cash flow to the what? To equity. Right? During liquidation, you have to pay what? Debt holder. Right? Sorry, a minute. Sorry. Sorry, please. I need to plug my phone, my system. Bring in increase slash decrease in the borrowing, right? Both the short term and long term borrowing. It is because you have to pay them. When you pay them, you have to pay the debt holder. When you pay them, and what is available, it is called the free cash flow to the what? To equity. Now the question now is, what will you use to discount, right? When the question says, what is the present value of the cash flow using the free cash flow to what? To equity. Now, you use the cost of what? Cost of equity to discount because this is free cash flow to the what? To equity. You use what? The cost of equity to discount to get the present value of your free cash flow to the what? To equity. Then you are done with free cash flow to the equity, to free cash flow to the firm, as well as what? Free cash flow to the to what? To equity. Now, in summary, what is free cash flow? What is available to the management, right? And they can decide on how to use it after deduction of all essential payments. Right? Free cash flow is divided into two. Don't forget, free cash flow is a form of valuation of a business. So we'll do a lot of free cash flow when we get to a valuation of a business because it is the combination of the two. Most time, the question we say using the asset base, using this, using that, as well as the present value of the cash flow using free cash flow to equity or firm. So you can see when we still get to merger and acquisition, we still make use of free cash flow. So this is just an introduction to free cash flow, right? Now, then free cash flow is divided into two. There is free cash flow to the firm as well as free cash flow to equity, right? Under the free cash flow to the firm, to the firm, right? Your profit after tax, add back non-cash item, depreciation, amortization, impairment, interest, the net interest, right? Then increase slash decrease in non-current asset, the replacement cost, if there is any, the working capital, the current asset minus current liability, excluding current asset, excluding what? Cash and cash equivalent, and the current liability exclude what? The short-term what? Short-term what? Short-term debt, right? Then there is then you use what? The weighted average cost of capital to do what? To discount because it is free cash flow to the firm, right? Don't forget when you are doing in real life, when you are doing a valuation of a business, you use the free cash flow to equity because you want to what is it called? You want to make an investment decision, right? You want to look at it what will be the upside potential in valuation, right? We want to look at it. Okay, should I buy this? Should I sell? Should I buy? Will you sell or not, right? Use free cash flow to the firm, to equity, right? So free cash flow to the equity, profit after tax, add back depreciation, amortization impairment. You will not add back the interest because this is free cash flow to the what? To equity, right? So the total amount you borrowed, you have to pay them. You have to pay it. The total amount you borrowed, you paid it before. You now have what is available to the what? To the equity holder. So it's now the discretion of the management to say, oh, we want to pay under the dividend policy, right? We want to pay them 3 naira per shares, 4 naira per shares. And you use what? You have to use the cost of equity to discount the free cash flow to get the present value of free cash flow to equity. And that is all about what this is all you need to know under the free cash flow to the firm as well as free cash flow to equity. So if you have questions before we look at an illustration, so I have an illustration here. Quickly, this question I think is one of the past questions thereabout, right? This is free cash flow. This is free cash flow. This is free cash flow. So if you have questions, you can quickly unmute your mic quickly so that we can complete this question. Our next class will now move to valuation of a business. At the end of this class, you should be able to solve I think class diet question 1 there about free cash flow. I think free cash flow to the firm and equity is there. I think you should be able to solve it, right? Using this format, right? Using that format, you should be able to solve the free cash flow to the firm as well as free cash flow to what? To equity. Now, illustration 1. Let's quickly look at this question together, solve it, and then so that we can move ahead. LA Limited, a food packaging company, has operated as a private company for the past 10 years. The company has been growing rapidly over the last few years. The directors are now considering listing the company on the stock market, right? Preparatory to this, the directors are interested in determining the what? A fair price per share for the company. Now, look at it. Don't forget, I mentioned it earlier that free cash flow is a form of valuation. You can use it as a basis of valuation. It's a technique of valuation of a business, right? You can see the company wants to do what? The director interested in determining a fair price per share for the what? For the company. They want to determine the market price per shares for the company, right? You want to determine the market price for the per shares for the company. Assuming today is August 1st, 2024. The following information has been extracted from the most recent audited financial statement of L Limited. I'm coming. Then this is the statement of profit or loss. Can you see it? This is your EBITDA, depreciation, EBIT. These are valuation, financial modeling terms, right? EBITDA, EBIT, and you have the profit after tax. Then this is the statement of financial position. Can you see it? You can see the cash and cash equivalent, cash and bank, account receivable, equity, bond, the short-term loan, right? Account payable. Can you see them? And this is the additional information. So before I go to the additional information, don't forget our principle here. Our principle is that when you see a question like this, the first thing you need to do, you don't need to stress. The first thing you need to do is that you do what you read the required. I've mentioned this several times that when you read the required, it is assumed and you understand the required. It is assumed that you have solved more than 70% of the question, right? Than someone who just see question and want to solve because it is free cash flow to the firm or free cash flow or because it is forecast or it is adjusted present value, right? You don't read the question, understand the required, then you cannot do what? You start. Now, when you read the required and you understand that, oh, this is free cash flow, oh, this is adjusted present value, the next thing you need to ask yourself, what are the steps? What are the steps? Don't forget, if it is adjusted present value, you say, oh, there are 2 items you need to look for in adjusted present value, which is the base case NPV and the PV of financing effect. The same thing applicable here. You say, oh, what are the things? Oh, it is free cash flow to equity. What are the formulas? What are the the format of what? Free cash flow to the equity. And that is the first thing you need to know, right? So, please, do you have questions? I'm seeing Uber, right? Am I correct? Okay, I think the mistake, right? Okay, the mistake. So, calculate the free cash flow available to equity for the year ended July 31st, 2024, right? Using free cash flow to equity model, calculate the current value per share. Calculate the what? Current value. Current value what? Current value per share. They want to know the market price per share, the current value. What will be the market price per share? Right? Don't forget that the company wants to list in the what? In the Nigeria stock what? Exchange, right? All right. Free cash flow to equity. So, okay, free cash flow to equity. So we start suggested solution. Suggested solution. So please, if you don't have, what we will do is that when we are done with free cash flow to equity, we will also do free cash flow to the firm. Although the question did not say we should do free cash flow to the firm, so we'll just add it, right? Please, you can screenshot the format, right? You can screenshot the format. I will send it for those who have actually made their payment for material. Immediately, on or before the next class, you will get the material on free cash flow. I will add what is it called, business valuation to it, so that you can make use of the two. Free cash flow, business valuation. So please confirm. Are we good? Okay. I guess we are good, right? Kemisire, are you in this class? Where is the exclusive? Exclusive. Absent. Favor. Are you still with us or against us?
I'm not
Yes.
absent though, boss. I'm not
Against
absent.
us.
Okay. Where is Kemisire? Then Benjamin. Mr.
Present, sir.
Moses.
Present, sir. Your boy is loyal.
They play. Just they play. Hey, I beg go. So suggested solution, right? Please don't forget that presentation matters a lot, right? Presentation matters a lot, right? So suggested solution, we have to calculate the free cash flow. We have to calculate the free cash flow to equity. So we'll start with what? Profit after tax. Okay, I think this is 6 minutes. The call will end in 6 minutes. I need to create another link so that. So I think we need to continue with our lecture. Others we actually join us, right? So we need to start from profit after tax quickly. See, there is no question how question wants to come under the free cash flow, either to the equity or to the firm. It is the way it is, what it is, right? It is what it is. It is just that format that you need. Once you understand it, then you move with that format, right? For those who have been joining us from the beginning of this of our lecture, you know that there is always a principle, right, that we adopt for every topic, and that principle still remains, still stands, and it's just for you to just go back to the principle. What is the principle behind this topic? Once you understand it, believe me, you can solve any question in that particular topic. Once you understand the principle, right? So we are starting with profits. Profit after tax. Profits. Please don't write part. Oh, you like write part. Part means part payment. Profits after profit after tax. Please, there you go. Don't write part. Oh, PAT. Part means what? Part payment. So profit after tax. Quickly, let's check. Let's go and check profit after tax in the profit or loss account. Oh, we didn't finish. Did we finish the additional information? Sorry. Okay, additional information. Before we go to the profit after tax, the following additional facts are available. The director believes that the free cash flow to equity model should be provided an appropriate valuation of the company shares. Can you see it? Of the what? Of the company shares. This is to tell you that free cash flow is another method of valuation of a business. Now, let me list them to you. Free cash flow is a method of valuation of a business. Economic value added is a method of valuation of a business. Shareholders value analysis is a method of valuation of a business. The merger, almighty merger of acquisition is what? Is a method of valuation of a business. So we still now have another methods, which are the what? The income based, the asset based, the dividend valuation. We'll get there. Right? So when they are talking about valuation, it is not only asset based, all these free cash flow are all they are all valuation techniques, right? Because this question is telling us that, oh, the directors believe that the company can use free cash flow to equity, right? Should provide an appropriate valuation of the company shares. What is available will be the market value, will be the value of the what? Of the company. So the what? So what is available now? And that's, oh, this is what is available to the equity. That is why in real life, in practice, you do your model, from your model to valuation of a business. You now say, oh, there's what we call upside potential, right? You now look at it. Okay, do you have an upside potential, right, or not? You look at it. Okay, I'm good to go. Let me buy these shares because there's an upside potential of 50%. The upside potential of 50% indicates that, oh, the share price will increase by 50% in the nearest future. We'll get there. And investment bankers has protected the following estimate of cost of capital, provided the following estimate of cost of capital, the cost of equity of 15%, post-tax cost of debt 4%, weighted average cost of capital 12.5%. The directors believe that the free cash flow to equity will grow by 18%. Class, another trick under the free cash flow, or we will still use it in the merger and acquisition, is that they will give you something. And what is it? The director believe that the free cash flow to equity will grow by 18% for the next 5 years. Class, what it indicates, or what it means, or what it shows, that if you have a free cash flow of 50,000 to equity, this 50,000, it will grow by 18% for how many years? For 5 years, right? We will get there. And by 5% thereafter. What is thereafter? Infinity, class. Infinity, from that 5 years to infinity, class. We'll get there. Now, the company currently, what is indicated? Let me analyze it, right? The first one indicates that you have 50,000 as a free cash flow to equity, right? It will grow by 18% for the next 5 years. After that, there will be 5% thereafter. That is infinity. That is when you grow it from 18 to 5 years. After that, there will be an infinity, 5% thereafter. There is a formula for that. We'll get there. The company currently has 600 million shares in issue. Calculate the free cash flow to what? To equity. Very simple. We'll do that. Now, from our format, we have profit after tax, right? Profit after tax. There's another way we can do it, but let's just move from this part, right? Profit after tax of 1,054, right? 1,054. So we add back non-cash items, if any, right? We'll add back what? Non-cash item. So we start from the profit or loss, right? From the profit or loss, there is one wicked question. I saw it somewhere. I have to go and check. Very wicked question. The question is that you will do free cash flow to equity, I think to equity or firm. After that, it includes capital budget. When you finish capital budget, you do modified internal rate of return before some other note, and it is 30 marks. I'll go and look for that question. I will look for it. Very wicked question. So after that, you have depreciation of 440, right? 440,000. Then we still have interest. So let's start. The non-cash item, right? Depreciation. We'll add it back 440 because it has been previously deducted, right? So the next thing we need to do from our format, do we have any impairments? We have interest. There is interest element, interest of which we have to net it. So we have to do 1 minus. We need to do 1 minus. What is the tax? What is the interest? We need to go back to check the interest so that we get our relief. What is the interest? I'm coming. So the interest is what? Is 330. So we will not pay 330. And what is the tax relief on that? Right? 330. So 1 minus tax rate. What is the tax rate, class? You need to go back and check. The tax rate is 30%, class. Is what? 30%. 0.3. So what do we have? 1 minus 0.3 times 330. What do you have?
231.
You have what?
231.
Okay, 231. Is that Olanike?
Yes, sir. Good evening, sir.
Okay. Yeah. Okay. Favor. Or you can. Or favor. What happened?
Yes, sir. In the free cash flow format, free cash flow to equity, there's no interest there. They
Oh,
won't give
thank
us.
you. You see? Thank you. Hey, Simio. It is well. Free cash flow to equity. Thanks for the observation. Free cash flow, FCFE. So, class, in free cash flow to equity, there is no interest. So, why am I bringing interest in? It is well. So, after that, we need to check for our increase / decrease in non-current assets, right? Because from our profit or loss, there is no amortization, no impairment, right? The only thing we have here as non-cash item that will reflect under the free cash flow to equity is just depreciation. So the next thing we need to look at is what is the non-current assets. We need to check either we have increase or decrease in non-current assets. Benjamin.
Yeah, thank you, sir. Please, I want to ask a question on these impairments. Okay, I want to know, is there a way the question can be free, maybe framed such that they will not mention impairments, and at the
Not
back of your
possible.
mind, you know that they're
This is
actually
not
talking about
it's not possible, Benjamin. This is not financial reporting. This is SFM.
So,
In strategic financial management, it will be mentioned that impairment is this. You will even see it in your statement of profit or loss. They may tell you that don't forget that you can classify in financial reporting, you can classify expenses as nature or by function. It could be that they may tell you that, oh, the impairment is in what? Is in the what is it called? You are given operating expenses and operating expenses. So they will actually indicate all these things. This is strategic financial management. Do you get?
Yeah,
Do you get?
thank you.
Yeah, you're welcome. So what next? What do we have? What next? We have increase slash decrease in non-current asset, right? Now, when you look at this non-current asset here, right? You have in 2023, you have this, right? In 2024, you have this. Something should come to your mind that it could be in 2024, the asset has increased, right? It could be they purchase more assets, right? Something should come to your mind that it could be that, oh, they purchase assets in what? In 2020 what? In 2024, right? That is why you have the increase to the 6,000 what? 224, right? Don't forget that this is the carrying amount of the asset in 2024. This is the carrying amount of the asset, right, class? In 2024, this 6,224. Let's go to financial reporting. This is the carrying amount of the asset. So what it indicates that could be that they've declared what? Depreciation of an asset. You know, in financial reporting, you have what? Depreciation schedule, right? Okay, oh, are we still together? Are we still together? And that is SFM. You need
Yes,
to
we
have
are together.
Felicity. Your face show. So after that, we need to do analysis on this what is it called? On this increase in assets. So workings 2024, 2023, right? Please. Okay, let me just do it like this. I think it has to be like this. Non-current assets. Non-current assets. Non-current assets. So you give me figure for, okay, I have to go back and check. 2023 and 2024. We must complete this question. We must finish it. We must finish it. Right. Oh, sorry. So we need to go back. Please screenshot. Let me have the figure. Can you see it? Non-current asset. Can you see it? You can see the way I analyze this question. In 2023, you have 5,942,000. In 2024, you have the carrying amount 6,224,000, right? Which indicates that in 2024, it could be that the purchase was an asset, right? It could be that they purchased an asset, and that is why you see it an increase. Now, don't forget that is the carrying amount of the what? The assets. Now, non-current assets. Oh. Please figure. What is the non-current asset? Can someone give me the figure?
624.
Okay. That's fine. Coming. Million. Right? So everybody should just calm down. Right? SFM is simple. Just understand the principle. Then we'll move from there. Feel free to reach out to me. Okay? So what do you have here? What do you have? Quickly. 2023.
2023 is 5,942. 5,942.
Okay. 5,942. Okay. Then 2024.
6,224.
Good. Now don't forget, class, that this is the carrying amount of this asset. This is the what? The carrying amount of this asset. So definitely depreciation, it has reduced. Depreciation has actually take place. What you need to do is that You add back your depreciation, add to get the cost of the assets, depreciation. So we go back and check. What is the depreciation of our asset? 440. 440. Now, we're not given any depreciation here. This will be new, right? But that wicked question, it has depreciation for the previous what? For the previous year. Now, when you gross it up, when you add it up, you add the real costs of the assets. You do what? You add the real costs of the asset. That is the costs amount, right? Good. So when you add it, what do you have? What do you have? Cost of the assets.
6664.
I'm coming.
6664.
Okay. 6664. So this we have 5942. So in this case now, what is the increase? You can see that from 5942 to 6664. Class, what is the increase? The difference is the increase, right?
72.
So increase,
72.
thank you. Increase in non-current assets. Increase in non-current assets. No, I will not do it this way. Give me the figure, though. You know that the difference is an increase. What is the difference? Sorry. What is the difference again?
722.
722.
72.
Thank you. Yeah. So we can go in our cash flow and write increase in non-current assets. Increase in non-current assets. So you can put work 1 so that we show that this is your workings, right? And this is 722. Increase will reduce your cash flow. Will reduce your what? Your cash flow, and that is why you have to jacket it. Right? After your increase in non-current assets, there is no replacement cost. If we check, it could have been mentioned. Exclusive. It could have been mentioned if there is a replacement what? There is a replacement cost. Exclusive.
Okay. Sir,
Okay.
please, can we also, for this non-current asset now, the addition, can we also say that the opening balance is 5942, then less depreciation, then you have a difference between the closing balance and then that's amount. Can we
Exclusive.
also go like that?
Exclusive. Do it the way you understand.
Sir,
Do it the way you understand. This is the way I feel you will understand it. Right? See, there is another way
okay,
of doing it. Oh.
okay.
Where I copied it from. They just do it anyhow. So your understanding, use it. Get your increase. The major thing is that get your increase. Is it decrease or increase? That's the major.
Okay, thank you.
Yeah. Any other question? Okay.
Yes, sir. Please, can we get a general note of saying this will cause an increase, this will cause a decrease in the PAT, like as you're adding back or lesson. Can we get what exactly?
I've done that.
I don't know if
I've done that at the beginning of the class. Did you join this class when we start at 8:30? Did you join?
yes, I did.
You did. But I've been mentioning the reason why it is increased and decrease from the format. Did I mention that?
Okay, sir. I'll follow up.
Okay, thank you. Thank you. So the increase, right? And again, Chimobi, it seems
Yes,
you
sir.
are chatting. It means I will just assume maybe you are chatting with that girl. Tell the girl to give you 4 months to excuse you for 4 months, right? Then after 4 months, you continue. So that your attention will not be divided. Don't worry, I will still explain it at the end of the class, but that will be at the end of the class. So increase in non-current assets will reduce your cash flow, decrease will add, right? Now, the next thing is your working capital, because no replacement of an asset was mentioned, right? So the next thing is what? Working capital. So we need to check for increase or decrease in what? In working capital. So therefore we have increase. Well, I don't know if it is increase. I have to go and check. Working capital, work 2. This is your work 2, right? Working capital. So I have to copy this. Do we need this? Do we need this in working capital? Yes. Your current asset minus your liability. Don't forget, current asset exclude your cash. Current liability exclude your what? Your short-term debt. So working capital, we need to check your current assets so that we subtract. We have the working capital, current assets. What make up the current assets? Okay, I have to arrange it. Current assets. Why I'm doing it this way is because this is the first class that I lecture on. In subsequent class, I will just bring out the current liability. So it is assumed that you should go back to the YouTube and check the formats, right? So current liability. So under current liability, we check what is under current liability. Don't forget that current liability exclude cash and cash equivalents, right? So what do we have under? Can you see it? Please confirm if you can see my screen. No, Chimobi, can you see my screen? Okay. Oh,
Yes, sir. I can see your screen.
okay. Now we will exclude this, right? Then this is our non-current asset. This is our current asset, sorry. All right. So we'll copy this. Okay. Copied it. Oh, stable, right? It will be difficult. Stable. What should we do? Okay, let me just bring this one down. Sorry, I need to arrange it. Sorry. Oh,